battle. They're talking about potential costs there of another 20-odd billion. Xetra DAX is just back over 7,000. The CAC went up 0.25% as well. But 5,900 for the FTSE. Some people had 6,000 as their target. There's still time to get there. At the same time, of course, Germany would be in a lose-lose situation if it had to lead a bailout of another member of the Eurozone. That's the view of Mohamed El-Arian, the CEO of PIMCO, writing in today's Financial Times. Joining us for more on this, Jeff Howie, Sales and Market Strategy at IMF Global Singapore. But first, we'll get over to you, Sylvia. And also, I just want to get your reaction to the PMIs, because there's a sharp difference between a slight decline in the business side for services, but manufacturing still doing very well.
Well, that's of course not only, but largely also to what's happening in Germany. Germany, as you know, has a very strong manufacturing base, and a few of the other countries are tagging along nicely. But Germany, of course, overexposed on the manufacturing side and underexposed maybe on the services side, and that might add to this discrepancy that we've got between services and the overall index. As to the view that Germany is in a lose-lose situation, I agree to disagree, frankly speaking. And if you talk to a number of economists also out of Germany or academics out of Germany, they also agree to disagree. Germany has been, from the word go, one of the main benefactors of the euro. Even now, even with the bailouts that we've already dished up for Greece and for our participation in Ireland, Germany is still the biggest benefactor out of the euro. Can you even imagine us being here with the Deutschmark, with the German currency and the German economy that's going from strength to strength, with essentially one ERM readjustment after the other, and the Deutschmark being the one strong obelisk that's standing out against everything else? The German economy would be in much more trouble. The German budget would be in much more trouble, and German politicians would have a lot more to explain to their taxpayers than they have to explain now. And when we keep talking about where the euro stands and whether the euro makes sense or not, especially in comparison to German monetary union 20 years ago, that was not necessarily economically motivated either, and it still happened. 20 years after that, we're still paying solidarity tax for East Germany. Maybe we need to do the same, maybe not as tax for Europe.
Jeff, yeah, I mean, is it hard for investors to look at the investment case, the economic case, but this is really all about the politics, and that, of course, that's a lot harder to predict.
A lot harder to predict, and also can be a lot more damnful. Essentially, you have the Brussels meeting tonight, as far as I can tell from what we're sitting in Singapore, into this EU meeting. There is actually quite a lot of division. You have Chancellor Angela Merkel asking for more ECB participation. You have Chairman J.C. Trichet asking for more German participation. It doesn't bode well for what is, in fact, the same day that Spain has its bond auction, last bond auction for the year, and that coming after the talk from Moody's last night on a possible downgrading of its credit. So, yeah, the divisiveness, I guess, if it is political, it is a distraction, and I guess we're all hoping for the same thing, which is an ultimatum that works out for the best of all, for all risk markets.
Yeah, Sylvia, how much of a tussle is there going on between the ECB and Europe's politicians?
I don't think it's such a big tussle between the ECB and Europe's politicians. I think it's a big tussle among politicians. The ECB might sometimes feel that the buck is being passed to them in terms of bearing the brunt of rescues, in terms of bond purchases, in terms of steering in monetary policy, etc. But at the end of the day, I think it's a tussle between Angela Merkel's hard line on a number of issues and Sarkozy more or less tagging along with her, but not out of political conviction, and some of the others, like Mr. Juncker, who's propagating the E-bond more loudly than others may be at this stage. And I have the feeling that if the last EU summit is anything to go by, where Frau Merkel basically threatened to walk out if they didn't toe her line, sorry to put it that way, I think we're probably going to see something similar, maybe a little more diplomatically, because the one thing that the Germans could easily give weigh on and could draw up a compromises by increasing the safety, the rescue umbrella. I don't think the Germans would actually have too much trouble in saying, okay, we double it from 750 to 1.5, or maybe we don't double it, but we increase it by another 300 billion. I don't think they would have the greatest problem with that, and that might be one of the little goodies that they could put under the Christmas table.
Meanwhile, Jeff, I mean, obviously this has been a big event for the credit markets, but I mean, for global stock markets, Europe's had no impact really at all. You look where the FTSE 100 is now, 5,900. We're up at sort of 24, or 2.5-year highs for European stocks, and look where the US stocks are. I mean, it's not fed into for stock investors.
It's not fed in, but as I said, it's possibly a distraction. You've had the 3-month TED spread essentially oscillating and consolidating between 13 basis points and 17 basis points since the end of August. Yet are households and consumers and businesses in Europe, are they actually exercising loans based on such great credit conditions? And if they're not, then obviously the overheat that's coming from the political circles is a distraction. Because, as you say, stock market, risk markets are actually fairly priced these days. They're actually possibly overextended. However, I think, especially for Europe, it's the leverage to developing Asia, especially China, and the strong export markets of Germany that's actually holding up much of the European bourses.
All right, hold on to your thoughts because we've got some more to get through. Jeff Howie, their sales and market strategist at MF Global Singapore. Well, China's central bank governor expressing more concern about excess liquidity in the markets. Zhou Xiaochuan says the country needs to soak up more of it. But today, the PBOC refrained from doing that via bond repurchase agreements. It kept the auction yield of its 3-month bills flat, in a sign that the central bank has, for now, given up open market operations as a main tool for draining funds. The PBOC governor also says China should continue to use banks' reserve requirement as